Welcome back. In this video, we'll walk through foreign-derived intangible income, commonly known as FDII. Using our corporate tax case study, we'll learn how FDII is computed, how it is reported on Form 8993, and how it ultimately reduces taxable income on Form 1120. Let's get started. Our U.S. corporation generated export sales revenue and foreign royalty income. This raises an important tax question. Can a U.S. corporation receive a tax benefit when it earns income from foreign customers while operating inside the United States? The answer is yes. Under Section 250, qualifying foreign-derived income may receive a deduction, which can reduce the corporation's effective U.S. tax burden. Before we begin the computation, remember that this FDII calculation is part of our larger corporate tax case study. The revenue figures, balance sheet amounts, and international tax calculations used here originate from our previously completed financial statements and GILTI module. FDII is not a standalone computation. It builds upon information already developed throughout the return. To compute FDII, we need several key inputs. These include export sales revenue, foreign royalty income, total corporate revenue, operating expenses, domestic QBAI, and certain international tax amounts already calculated under the GILTI rules. These figures provide the foundation for the entire FDII computation. The FDII calculation follows a structured 7-step framework. We'll first identify qualifying foreign-derived receipts. Next, we'll determine deduction-eligible income and foreign-derived income. Then we'll compute deemed intangible income and FDII. Finally, we'll apply the Section 250 deduction and see how it impacts Form 1120. The first step is determining foreign-derived gross receipts, or FDGR. FDGR represents revenue earned from serving foreign markets. In our case study, the corporation earned export sales revenue and foreign royalty income. When combined, these amounts produce FDGR of $4.675 million. This is the pool of receipts that potentially qualifies for FDII benefits. Next, we compute gross deduction eligible income, commonly called gross DEI. However, not all income is eligible. Certain international income categories, such as GILTI and the Section 78 gross-up, must be removed from the calculation. After excluding those amounts, gross DEI equals approximately $21.7 million. This becomes the starting point for determining eligible income. Now we subtract corporate expenses. Why? Because FDII applies to profit, not revenue. The IRS requires corporations to consider the expenses incurred in generating income. After subtracting operating expenses, our net DEI base equals approximately $2.665 million. This represents the corporation's remaining eligible profit pool. Next, we determine foreign-derived deduction-eligible income, or FDDEI. At this stage, expenses must be allocated between domestic and foreign-derived activities. The objective is to determine how much profit is actually attributable to foreign customers. After allocating expenses, our FDDEI equals approximately $1.038 million. Notice that FDII benefits are based on foreign-derived profit, not merely foreign-derived revenue. Now we calculate deemed intangible income, commonly known as DII. Before doing so, the tax law removes a routine return on tangible domestic assets. This routine return is called DTIR and equals 10% of domestic QBAI. Congress intended FDII to reward excess returns that resemble intangible income rather than ordinary returns generated by physical assets. After removing the routine return, our DII equals approximately $1.873 million. Next, we determine what portion of that deemed intangible income is connected to foreign-derived activities. Using the FDDEI ratio, we isolate the qualifying portion of DII. The result is FDII of approximately $730,000. At this stage, we've identified the amount eligible for the Section 250 deduction. Now we reach the actual tax benefit. Under the rules applicable to this case study, corporations may claim a 37.5% deduction on qualifying FDII. Applying that percentage produces a Section 250 deduction of $273,603. This deduction is the primary benefit provided by the FDII regime. The completed FDII computation is reported on Form 8993. Throughout the form, we move from gross DEI to net DEI, then to DII, FDII, and finally the Section 250 deduction. The final deduction amount ultimately flows from Form 8993 into Form 1120. Unlike GILTI, which generally increases taxable income, FDII works in the opposite direction. The Section 250 deduction enters Form 1120 as a special deduction and reduces taxable income. This is where the corporation realizes the tax benefit. Let's look at the impact. Before applying FDII, taxable income was approximately $5.434 million. After applying the Section 250 deduction, taxable income falls to approximately $5.16 million. This reduction is entirely attributable to the FDII deduction. Notice the contrast. Section 163J created no change in taxable income. GILTI increased taxable income. FDII reduced taxable income. FDI was introduced to encourage U.S. corporations to serve foreign markets while retaining operations, employees, and valuable assets inside the United States. In our case study, the deduction reduced taxable income by approximately $274,000. This demonstrates how export-related income may receive favorable tax treatment under Section 250. Let's summarize. FDII begins with foreign-derived revenue. Certain international income categories are excluded. Routine returns on tangible assets are removed. The remaining foreign-derived intangible income becomes eligible for a Section 250 deduction. And ultimately, FDII reduces taxable income on Form 1120. This case study uses simplified assumptions and hypothetical facts for educational purposes. Actual tax results may vary based on specific facts and current tax law. Thank you for watching. If you found this case study helpful, follow the channel for additional U.S. corporate tax case studies and step-by-step learning modules. See you in the next lesson.